Volatility could be a difficult thing for us investors to deal with, especially when investing in the stock market and equities. Big swings in the stock market could happen. Of course, we see those account values or our account values go up and down. Sometimes there could, be big swings, or it could have high volatility. So the question is there a particular set of product or ETF that could really help with that and have lower volatility while still staying invested in equity? So the answer is yes. It turns out that BMO ETFs, who by the way is the sponsor of this video, I'd like to thank them. I'd like to thank BMO ETFs for sponsoring this video. They have a product suite of low volatility ETFs, and we're going to explore these ETFs in detail. We're going to focus especially on the one that's focused in Canada, which is their biggest one by AUM. We're going to look at how these ETFs work, what's inside of them, the fees, etc., etc. All right, everyone. So BMO does have quite a big lineup of low volatility equity ETFs that are really designed for investors looking to be invested in stocks, in equities, but have lower volatility. But we're going to focus today on ZLB, the BMO Low Volatility Canadian Equity ETF. This is, like we're going to see in a second, their biggest one in terms of AUM. But just as a side note, they also have ZLU, the BMO Low Volatility U.S. Equity ETF. They have ZLI, the BMO Low Volatility International Equity ETF, and ZLE, the BMO Low Volatility Emerging Markets Equity ETF. So obviously, the difference between them is really going to be on the geographic area that the ETFs focused on. But all of them have equities, or it's 100% equities, 100% stocks, and focus on lower volatility equity. So let's focus on ZLB, the BMO Low Volatility Canadian Equity ETF, which focuses on Canadian stocks. And if we scroll down and look at the numbers here, you could see here, as of September 9, 2024, this ETF has over $3.8 billion in AUM. The MER is 39 basis points. And this ETF in particular does have a distribution. It's a quarterly distribution, and the annualized distribution yield as of August 31st, 2024 is 2.37%. So of course, if we scroll down and you'll look just very quickly here on the distributions, you could see the entire distribution history here. You could scroll throughout the years here, starting from 2011 all the way to 2024. And I'm not going to show it in detail, but the distributions have only either stayed the same or increased over time. They never reduced the distribution, which is very interesting here. So, and a positive definitely for investors. So if we just go up and look back at the fund benefits. So this ETF is designed for investors looking for growth solutions, right? Growth solutions, typically that language is associated with stocks or equity. So this is going to be, like we're going to see in a second, an equity ETF. Exposure to diversified Canadian equities, so Canadian stocks, and it's going to be, sector diversified. And here's the key. Holdings consist of Canadian equities with lower volatility than the market. So obviously this is an actively managed portfolio of stocks that they're picking and choosing stocks or equities that have lower volatility than the market. And if we scroll down, we'll be able to see all of those stocks in this particular ETF here in the holdings section. If you click on all holdings, you'll see them all as well. I'm sure if you're Canadian, especially if you're Canadian, you'll recognize a lot of these companies like Metro, Loblaw, etc., etc. But what's interesting, if you scroll down, because I'm not going to go through all the stocks one by one, is the sector allocation. So this is where you'll see the difference within this ETF and other Canadian equity focused ETF is really the sector allocation. You see financials is quite a big chunk, like your typical, diversified Canadian equity ETF, but you see a really big percentage in consumer staples and utilities, which tend to be more defensive sectors, and you don't see any energy stocks at all. So we know energy stocks like oil and gas producers tend to have higher volatility, so these are not included in this portfolio of stocks. So now let's do a comparison, right? So let's compare ZLB, the BMO Low Volatility Canadian Equity ETF, to three other BMO ETFs that focus on Canadian equities. And I really want to focus on two things: the performance between the four and the sector allocation. So we're going to do the comparison to ZCN, the BMO S&P TSX Capped Composite Index ETF, which is an ETF that invests in, it's a passive index ETF that invests in the overall Canadian stock market. We'll also do the comparison versus ZDV, the BMO Canadian Dividend ETF, which is an ETF that focuses on Canadian dividend stocks. And last but not least, ZWC, the BMO Canadian High Dividend Covered Call ETF, which is an ETF that also focuses, just like ZDV, on Canadian dividend stocks, but also uses a covered call strategy. So if we scroll down, you'll see all the different stats between them. You could go through it yourself. Again, I'll put the link to this tool in the video description below, but what I really want to focus on is the performance. So if we look at the last 10 years of performance, it's average annualized, it's 10.3 versus 7.4 versus 5.9. This one hasn't been out for 10 years, so we can't do the comparison. So for the 10 years, ETF here has done really, really well, the highest performer. If you look at the last 5 years annualized, it's 9.4 versus a 10.4 versus a 9.2 versus a 6.1. If you look at the 3 years, et cetera, you could go through it yourself. But just to say that ZLB, the BMO Low Volatility Canadian Equity ETF, has fairly good performance compared to other ETFs that are also Canadian equity focused. Even though it has low volatility stocks. And that brings me to the second thing I want to show you, the sector allocation breakdown between these 4 ETFs. And what you'll notice right away is the lack of energy stocks is the first thing you'll notice. And it has much less financials allocation versus the other ones. It does have some, but it has no energy, less financials, and a lot more consumer services. So that is really the big difference between these ETFs here. So very interesting sector allocation breakdown. Obviously, this is where the active management comes in, and they're choosing lower volatility stocks for this portfolio. So yeah, there's a comparison. And again, if you guys want to do some more detailed investigation or research, you could use BMO's great tools here. There's the ETF/fund comparison tool where you can compare any ETFs you want. You'll get the performance breakdown. There's also the ETF screener to look at detailed information, so I highly recommend it. I will put the links to these tools in the video description below. All right, everyone, I am joined by a special guest today, Aaron Allen, VP of BMO ETFs Online Distribution. Hi, Aaron. How's it going? Thanks so much for taking the time.
I'm great. Nice to see you, Adrian. Thanks for having me today.
Yeah, nice to see you again. And today we're going to talk about the BMO Low Volatility ETFs. So, of course, the first question that I think is a general question, right? For what type of investor are these BMO Low Volatility ETFs designed for? Who did you have in mind? What the target?
Yeah, good place to start. They're really designed for the defensive-oriented investor who still wants growth. So those who want to be in the equity market but are looking for lower risk relative to the broad market. And we launched them in 2011. That was our first listing with ZLB, the Low Volatility Canadian Equity ETF, really out of the pandemic, or not the pandemic, the global financial crisis in 08, 09. Investors were, hurting. They wanted to get out of their positions, but couldn't because they were in such a deep hole. And so they're really asking the question, how do I stay invested with lower risk? And that's really who we launched these for. And they've delivered on that goal really over the past 10 years.
Yeah, for sure. And we'll definitely talk a little bit about performance a bit later. And I find there's a common misconception with investing with the terms. What do you think is really the difference between risk and volatility? I know these terms are used interchangeably. What do you think is the difference between them? What would you say?
Yeah, good question. I think from my perspective, risk is the potential for loss. So it's sort of capturing that uncertainty regarding your investment returns in the future. Measured by the likelihood that you're going to lose money or not achieve your expected returns. That's sort of how I define risk. Whereas volatility is more of a technical term. It's a measurement of price movements or price variability on a day-to-day basis. And there's really 2 popular ways that volatility is measured. The first being standard deviation, maybe the more common approach, which just measures the variation of a stock's price over time. So really measuring the volatility relative to itself. And then there's beta, another measure, the one we use in our approach at BMO that looks at volatility relative to the market. And it's typically a more stable measurement, and we feel it's better suited for a low volatility approach because generally speaking, investors are trying to lower the volatility relative to the broad market. So And when you're looking at low volatility strategies, it can vary. Some will use standard deviation, some will use beta. I mentioned we use beta. Just make sure you're understanding the approach and looking under the hood, because the name doesn't often tell it all, right?
Yeah. Yeah, excellent. Well, that makes sense. I think that that's correct as well. I agree with you where volatility is more of a technical term. Price movements, the higher the volatility, the more there could be price movements in whatever asset you're investing in, which means price movements of your account, your investing account value. So if you want lower volatility, you just want less movements, right? So we talked about ZLB. This is your the Canadian low volatility ETF that you guys have been managing since 2011. Like you said, it's been out for over 10 years. And I have to admit, this is my personal opinion, of course, performance has been pretty impressive, especially compared to other Canadian equity or Canadian stock centric ETFs that you guys manage as well, that BMO manages, like ZCN, ZDV, ZWC. So what do you attribute this success to? The performance typically of a lower volatility product is typically lower than the overall market. I'm saying typically here, but the Canadian one, ZLB, very solid throughout the years. What do you attribute the success to?
Yeah, this is sort of it's called the low volatility anomaly, and it's not something people think about. They think more risk equals more returns, not the
Right.
other way around. But really, that is in effect what low volatility has done over the long term. And we've been fortunate to have a strong performance. It's one of our most award-winning ETFs, fund grade A+ award, Morningstar awards. What I attribute it to, I guess generally speaking, is just the power factor investing and the power of factor investing, which is really taking a different approach versus the market. And in this case, of course, a lower risk approach. And sort of what that leads to is a very different sector exposure in the portfolio.
Yeah, the exposure of ZLB is very different than, a generalized Canadian equity, Canadian stock ETF.
Yeah.
So
Canadian, we think it's going to be high in energy, and this portfolio actually has no energy.
zero energy. Yeah, I noticed that.
Zero energy right now. It has had some energy companies in the past, but right now, oil's volatile, so it doesn't always make the cut. And it's not going to work every year. So there's going to be some years where that's going to hurt the portfolio, but we have again seen over the long term that it's been effective. Consumer staples, probably the number one sector in the portfolio. Those household names, things we can't live without, the defensive companies that we all know and love. That's what you're going to see really representative in this portfolio. But again, it's not going to perform across all market cycles. There are going to be these indiscriminate rallies where energy takes off or otherwise where you might lag the market. But I also like to think of the portfolio as a completion portfolio. So if you hold ZCN or TSX capped composite ETF, you can add this to that and you can sort of have a more complete diversified sector picture at the end of the day that's not so focused on where Canada is usually heavy.
Yeah, that's true. That's a good point. And we're focusing on ZLB in this Q&A, but you have the other regions are covered as well. Same type of strategy, I believe. It's still looking for those low volatile stocks. But yeah, consumer staple stocks, like Metro, Loblaws, things like that make up quite a big portion of the ZLB portfolio, like I showed in the video earlier. So okay, well this channel is technically passive income investing, so I got to ask you about the cash flow of the ZLB ETF. So I understand that cash flow, the distributions is not really the main focus, maximizing, but a lot of the stocks or equities inside the ZLB ETF are, dividend stocks. And what I've noticed is I've analyzed the distribution history of ZLB, and I noticed that it's been increasing over time. It is a quarterly distribution. It's been increasing over time. You guys never reduced it. You've only ever left it the same or increased it. So what do you attribute to that positive aspect? Do you expect this trend to continue?
I think it all comes back to sort of the methodology and how we manage this portfolio. Looking at the low beta stocks, it's really going to be those stronger companies with more cash flow, with stronger dividend growth over time, lower risk stocks. So it's not a cornerstone of the portfolio to increase the distribution over time, but it's a happy result of it, I guess. And definitely that's going to compound over time. And that's what we're seeing in the history.
Excellent. Well, Erin, you've been great. That's the only questions I've had. Fantastic ETFs to consider if you're an investor looking to have a little bit lower volatility in your portfolio. But like you mentioned, that still want growth because these are stocks. These are equity ETFs, right? It's not like we're adding 40% fixed income asset class in these ETFs. They are pure stocks, but these are actively managed ETFs, really trying to pick and choose the lower volatility stocks, which performance doesn't lie. It's been pretty good so far. So thanks again for your time and hope to see you again soon.
Thanks for having me, Adrian. We'll see you soon.
Take care.